In 1973, Warren Buffett bought a company worth $400 million. He paid $80 million for it. That's not a typo, and that's not luck. That's a concept called margin of safety. Master it, and you can do what Buffett did. Ignore it, and the market will eat you alive. I've watched investors lose fortunes for one simple reason. They confuse a low price with a good price. Those are different things. A stock at $30 isn't cheap. It's cheap relative to something. And the something is intrinsic value. Today, I'll show you the exact 3 methods I use to calculate margin of safety on any stock. No PhD required. Just a calculator, a free annual report, and the patience to do the math. And the third method is the one most retail investors completely skip. Picture an engineer designing a bridge. He calculates the maximum load, say, 10,000 pounds. Does he build it to handle exactly 10,000 pounds? Of course not. He builds it for 30,000. Because life is unpredictable. Trucks get heavier. Storms hit. Materials weaken over time. That gap, between what the bridge needs to hold and what it can hold, that's margin of safety. Investing works the same way. You estimate what a business is worth. Call that intrinsic value. Then you only buy if the market price is dramatically lower. 25% lower. 40% lower. Sometimes more. That gap is your protection. Against bad math. Against unexpected recessions. Against your own optimism. Benjamin Graham, the man who taught Buffett, said 3 of the most important words in investing are margin of safety. Not earnings growth. Not analyst ratings. Not technical patterns. Margin of safety. Now the question. How do you actually calculate intrinsic value? There are 3 methods serious investors use. Method 1. The Graham number. This is asset-based. Take the square root of 22.5 times earnings per share times book value per share. That sounds complicated. It's not. If a stock has earnings of $2 per share and book value of $15 per share, the Graham number is about $26. If the stock trades at 15, you've got a 42% margin of safety. Method 2. The Graham formula. This is earnings-based. Take earnings per share, multiply by 8.5 plus 2 times the expected growth rate. So a company earning $3 per share, growing at 5% annually, is worth about $55.50. Method 3. Discounted cash flow. This is the one most people skip. Project the company's free cash flow for the next 10 years. Discount each year back to today using a rate around 10%. Add a terminal value. Sum it up. That's your intrinsic value. Sounds intimidating? It takes about 20 minutes once you've done it twice. And here's where it gets really interesting. Back to 1973. The market is crashing. The Watergate scandal is everywhere. Investors are panicking. Warren Buffett is reading. Specifically, the Washington Post company's annual report. He runs the numbers. The company's intrinsic value is roughly $400 million. Real estate. Printing equipment. Cash flow from advertising. A near monopoly in the DC newspaper market. The market cap on the New York Stock Exchange? $80 million. Buffett doesn't blink. He buys $10.6 million worth of shares. By 1985, that stake was worth over $200 million. By 2007, when Berkshire began trimming the position, his stake was worth over $1 billion. From an $11 million bet. The lesson isn't that Buffett is a genius. The lesson is the math worked. The price was $80 million. The value was $400 million. The margin of safety was 80%. When you buy $1 for 20 cents, time does the rest. So how do you use this tomorrow morning? 5 steps. Step 1. Pick a company you actually understand. If you can't explain how it makes money in 2 sentences, skip it. Step 2. Pull the most recent 10K from the SEC website. It's free. Always free. Step 3. Calculate intrinsic value using all 3 methods. Take the average. Or if you want to be really conservative, take the lowest of the 3. Step 4. Demand a margin of safety of at least 25%. For riskier businesses, 30 to 50%. The cheaper you buy, the more wrong you can be. Step 5. Be willing to wait. Sometimes for years. Buffett famously kept a list of companies he wanted to own at the right price. He waited a decade for some of them. The market gives you opportunities, but only if you're patient enough to demand them. Here's the principle that changes everything. Most investors ask the wrong question. They ask, will this stock go up? Wrong question. The right question is, what is this business worth, and what am I being asked to pay? Once you answer that, once you have a number, the market becomes a tool, not your master. Margin of safety isn't about being right. It's about surviving when you're wrong. What's the largest gap between price and value you've ever found in a stock? Tell me in the comments, I read every single one. And if this changed how you think about valuation, hit subscribe. Tomorrow, we're tackling something I've been waiting weeks to cover: why the smartest investors actually want recessions. This is educational content, not financial advice. Always do your own research. See you tomorrow.